This is the executive brief for Sample Equipment Company, presented by Rainier Business Intelligence. The income statement and balance sheet are normalized to reflect business operations with market rate expense, asset, and debt structure. The income statement provides a financial summary of the firm's operating results during a specific period of time. The balance sheet presents a summary statement of the firm's financial position at a given point in time. The focus of this report is on the assets deployed to generate earnings, since the debt and equity structure of the business is likely to change in a purchase and sale context. Earnings before interest, taxes, depreciation, and amortization, or EBITDA, identify operating cash flows generated by the company. Seller discretionary earnings captures the impact of officer compensation. Cash flows are represented for the historical and projection period. The premise of valuation most often used is fair market value and is defined as the amount at which property would change hands between a willing seller and a willing buyer when neither is acting under compulsion and when both have reasonable knowledge of the relevant facts. The asset approach presents the value of all tangible and intangible assets and liabilities of the company. This approach typically begins with a book basis balance sheet and restates the assets and liabilities to fair market value. The market approach has an underlying concept where the value of a business can be determined by reference to sales of reasonably comparable guideline companies that are known to have taken place in either the public or private marketplace. The income approach to valuation is the process that links risk and return to determine the worth of an asset. Value estimated in each approach is weighted based on the analyst's judgment. We've relied on the income approach given the volatility of earnings in the projection period. A financing structure has been assumed. The use of funds show the elements of the acquisition and costs associated with financing, including the SBA guarantee fee. The source of funds shows the loan amount and the buyer's cash injection. Debt service coverage measures the capacity of the company to repay proposed debt based on the historical cash flows. The pro forma cost and income structure address the first 5 years of operations. Net cash flow to equity owners represents the cash available to equity owners after the firm has met all operating needs, paid for investments in current and fixed assets to keep the company healthy in the projection period, and met debt principal payments. Return on equity for the new company in the pro forma period compares net income with total asset turnover and the assumed financing structure to identify return on equity. The assumptions and limiting conditions are an essential part of this report. For more information, contact Rainier Business Intelligence.